Payments Bank. You might have heard about Payments Bank more recently because of a leading payments bank getting a notification from RBI to stop any further onboarding of customers as well as its wallet operations. You know I'm referring to the Paytm Payments Bank. So that brings me to my topic on what exactly are payments bank and what led to the advent of payments bank in India. Also, I'll be discussing with you what's going on with Paytm or more specifically Paytm Payments Bank. Now, before we begin further in our topic, we need to understand two important questions: the why and the what, which means why are payments bank or why were payments banks introduced, and what exactly are payments banks. So, to address the first question, we need to turn couple of pages back into history and understand India and the issue of financial inclusion. A large chunk of the population in India, couple of decades back, was actually out of the financial inclusion ecosystem, or simply speaking, underbanked. And hence, the government has since then, along with the RBI, taken constant measures to bring the underbanked section of the society into the financial inclusion ecosystem. For example, couple of decades back, the concept of NBFC MFI or the microfinance institutions were introduced with the idea to cater to the lower sections of the society. By the lower sections, I mean to say the section which either is belonging to a lower income group and hence has not been catered to by the traditional banking network, or that section of the society which resides in such remote areas where they do not have a bank branch or a banking service. However, in roughly 2009-2010, India saw a major MFI crisis in India. And then in 2013-14, again we were poised with the question that what exactly needs to be done to enable the financial inclusion ecosystem in India. For this purpose, the RBI and the government appointed an external third party committee which was headed by Nachiket More and hence known as Nachiket More Committee. And this committee came up with certain recommendations for the financial inclusion. Now, one of the key recommendation was our topic of the day, payments banks. Now, why did the concept of payments bank come as a key recommendation from Nachiket More Committee? Because at that time, Nachiket More Committee thought that it would be good to leverage on the wallet ecosystem in India. Now, imagine if I am depositing some money with my wallet, which is with MobiKwik. MobiKwik is not paying me any interest, right? However, as a customer, it facilitates payments and remittances to me, and as a customer, that is one of the reasons why I am keeping my money in that wallet. Now, the Nachiket More committee wanted the wallet ecosystem to pay interest to the customers on the wallet balance, and hence they formally wanted to introduce it as a payments bank ecosystem. Now, furthermore, the Nachiket More committee wanted to leverage one of the key organizations of India, which has very deep roots across rural and remote geographies as well, which is the Indian Post or the Indian Postal Service. So the idea at that time was that if each branch of Indian Post actually ends up acting as a payments bank as well, wherein those customers who are able to access the branch of the Indian Post can actually deposit some money into the branch and have their account opened with the branch. This would facilitate such customers to have a bank account at the primary point and also to enable them to make payments and remittances because of this particular exercise. And hence, the concept of payments bank was something which came out as one of the key recommendations of Nachiket More committee. Now, how exactly would these payments bank work is one of the key underlying questions, which means what exactly are payments bank? So with the payments bank at the center, imagine a branch of Indian Post which is also acting as a payments bank. So a customer goes to the bank branch, deposits some money into the branch, and gets his or her account opened with the branch. And given that the customer is only allowed to have demand deposits with the payments bank, that means that the customer will open a current account or a saving account with the bank and not actually a time deposit account with the bank. And hence, the payments bank can offer a CASA account to its customers. Now, for whatever money the bank takes from the customer as deposits, the RBI prohibited such banks from lending activities because any lending activity would actually involve some sort of credit risk. And given this is catering to the lower sections of the society, credit risk is something which the RBI did not want such organizations to have. And hence, the RBI mandated such payments banks to deposit all of the money which they take from the customers through into safer instruments. For example, the RBI mandated such payments bank to deposit at least three-fourths of their demand deposits into the government securities and treasury bills, and that too with maturity period of less than or up to 1 year. Second, the balance of maximum 25% was mandated to be deposited into demand deposits or time deposits of other banks and financial institutions. This means that the bank was supposed to have decent liquidity or sufficient liquidity so as to enable any customer to withdraw money easily from their accounts as well as make payments and remittances easily. Second, the idea of not giving any credit risk or not allowing the payments bank to have any credit risk further ensured that the money is not used up for any risky activities. The banks were further allowed to sell products which do not have inherent credit risk. For example, insurance and investment products, which means that in essence, the payments bank were allowed to earn through primarily two sources of revenue. One was the spread on the deposits. So, for example, if as a payments bank, the payments bank pays to the customer 4% and earns 4.5% on its own investments, this allows the payments bank to have a 0.5% spread on the money. Second, if the payments bank sufficiently sells insurance or investment products to the customers, it will also be entitled to earn some sort of commission from the product manufacturer. All in all, while this seemed to be a decent playbook, however, the initial question which was raised was why not just ask a wallet to simply start paying interest and not introduce a formal concept of payments bank? However, given this was thought to be a better solution, Payments Bank was actually introduced formally in roughly the year 2015-16, and therein started the concept of Payments Bank in India. Now, the interesting part is that this particular concept was actually something which was derived in India itself, and it is not a Western concept which was brought into India. Now, while I've discussed how a payments bank work, I'll contrast it with a commercial bank or a small finance bank. So to understand this, firstly, the deposit which a payments bank can undertake from the customer in the form of demand deposit, was initially limited or capped at 1 lakh rupees for each customer. However, in April 2021, the RBI issued a notification wherein it doubled the cap on the deposits. So now a payments bank is allowed to take a maximum of 2 lakh rupees of deposits from customers, whereas a commercial bank or a small finance bank actually has no limit on the deposits. Second, to form a payments bank, the company needs a minimum capital of 100 crores, which is significantly less than what is required by a small finance bank, that is 200 crores, and what is required by a commercial bank, which is 500 crores. Third, in terms of statutory liquidity ratio or SLR, as I told you, for a payments bank, the 75% which it will have to keep with the GSEC and T-bill is what is SLR. Similarly, for a small finance bank, minimum 75% of the funds or the deposits need to be kept in priority sector lending. That is defined separately. And for commercial banks, it is roughly at 18% SLR requirements currently. Fourth, for a payments bank, as I told you, the RBI has prohibited such banks to undertake any credit risk. However, for a commercial bank and a small finance bank, credit risk is allowed, which means both of these banks can actually end up doing lending activities. Furthermore, RBI has also prohibited payments bank from forming subsidiaries as NBFCs to undertake the lending activities. Now, what does all this mean? First point is that for a payments bank, it is acting more as an intermediary wherein it is just earning the spread on the deposits. And the commissions are an add-on wherein it can earn further commissions by selling investment and insurance products. Second, if you look at it, the ideal way out would be for a wallet player to become a payments bank player, for a payments bank player to further become a small finance bank, and for a small finance bank to become a commercial bank or a universal bank. Now you can actually see this playing out in real life. To start with, Paytm, which started as a wallet company, ended up taking the payments bank license and started Paytm Payments Bank Limited or PPBL. Similarly, Airtel Payments Bank and other payments bank are trying to get small finance bank license from RBI so that they can start up doing the lending business. Third, if you look at some small finance bank, for example, AU Small Finance Bank, it has been granted a universal bank license from the RBI. And similarly, other small finance banks, for example, Ujjivan and others, are or want to actually get a universal bank license in the near future. And hence, this is a natural journey which each of the players are following. Now, when this concept of payments bank came out in the mainstream, 41 players applied for the license and 11 players were granted the license. In the image, you can see 6 players who are currently having the license, and the other 5, and out of the other 5, 3 players gave up their license and 2 were declared defunct. So the 6 players which are having payments bank license in India right now are Airtel Payments Bank, Fino Payments Bank, which is a listed company, NSDL Payments Bank, which had filed its DRHP, Indian Post Payments Bank, Paytm Payments Bank, which again is listed via 197 Communications, and Geo Payments Bank, which I think is included in the Geo Financial Services. Now, with this, couple of key questions come into mind. One is, what exactly are the revenue streams for the payments bank? And then again, a typical discussion of what are the pros and cons of a payments bank. So, if we are to discuss the revenue streams, we can take Fino Payments Bank and understand what exactly are the revenue sources for Fino Payments Bank. This graph which I have taken is from the quarterly presentation for Q4 FY24 from the quarterly presentation of the company. Now, if you look at it, 23% of the revenue came from CASA accounts, which means current account savings accounts of the customers. 9% came from CMS, which means cash management services. 5% of the revenue came from MATM, which is micro ATM services. 6% came from AEPS, which is Aadhaar enabled payment services. Another 29%, which is the maximum or the largest chunk, came from remittance services, which actually shows how important it is to provide remittance services to the customers or the target customers of the payments bank ecosystem. Another 8% came from BC banking, which is business correspondence banking. For example, if a HDFC bank is not present in a particular geography, which is let's say a remote geography, and wants to actually provide services in such a geography, it might go on and appoint Fino Payments Bank as a business correspondent of HDFC in such a geography. And in turn, Fino Payments Bank will earn some revenue from such BC banking. Another 9% in Q4 FY24 came from digital payment services, and lastly, the balance 11% came from treasury and other activities. All in all, if you have to understand, while the key or the primary revenue sources seemed to be spread on deposits as well as commission on investment and insurance products, however, in reality, one of the key revenue streams for such companies forms to be remittance services and money transfer services. And now, in terms of pros and cons, while the payments bank is enabling the lower sections or the underbanked sections of the society to come within the financial inclusion ecosystem, however, they are not able to scale to a significant extent. That is primarily because these banks are not allowed to do lending activities. And secondly, they are playing on thin margins whereas their operating cost actually ends up being higher to provide these services. Now, just pressing on my point further, in a recent interview, former SBI chairman Rajneesh Kumar said that Payments Bank is a flawed business model and needs a relook in light of recent happenings. Just to quote, when he was asked about Payments Bank, he said that ideally banks are making money by taking deposits and lending. But in case of Payments Bank, because such banks are not allowed to do lending activities but are mandated to deposit the money in government securities, which in turn themselves are low cost deposits, it means that the operational cost is very high for mobilizing the CASA savings. However, the return is not that much. And hence, he says that as a banker, even he himself was apprehensive when the payments bank model came because narrow banking does not work. Narrow banking, as in, he's referring to the thin spread on which these banks will have to work because they are not allowed lending activities. Then he's further asked that what are his thoughts if the banks are allowed to offer microloans. Then he rightfully says that then what will be the difference between a small finance bank and a payments bank? Because as I told you in the difference, the key difference between a small finance bank and a payment bank is that the small finance bank is allowed to take credit risk. Lastly, he's asked about the future of payments bank in India. So he says that because there is no money in payments after UPI, therefore Payments Bank is a very flawed model because of the high customer acquisition cost. So just to double click on his point, understand the point that to make a UPI transaction, you need a bank account, right? And the sole proposition which Payments Bank have is that their core customers are those customers which are not being offered services by a traditional banking network, which means that even if the UPI is the preferred method of payment, the customers will open accounts with a payments bank if they are not catered to by the traditional banks. However, the key highlight or the important point here also is that given remittance is a key source of revenue for payments bank, if a customer actually ends up using UPI as a payment method, the key source of revenue will be hurt. And that is why he's mentioning or he's saying that if UPI is being used, then Payments Bank actually has no future as a model, which means that in essence, small finance banks actually look more lucrative than a payments bank because they are allowed underwriting facilities. So with this, we have covered why did payments bank come into picture, what exactly are the payments bank from a regulatory landscape as well as in comparison with other types of banks, and then we have covered what are the revenue streams and what are the pros and cons of such a bank. Now, there are one or two other regulations for payments bank. For example, minimum 25% of the branches are required to be opened in remote underbanked areas. And with this, there are other regulations, but I've highlighted key regulations here to make the topic easier to understand. And now with this, while we have discussed Payments Bank, we'll jump on to what is going on with Paytm Payments Bank. So firstly, we'll come to the RBI notification against Paytm Payments Bank Limited. So under Section 35 of the Banking Regulation Act 1949, the RBI asked the PPBL to not accept any further deposits or credit transactions or even top-ups in the customer accounts, prepaid instruments, wallets, FASTags, NCMC, etc. after 15th March. Earlier the timeline was Feb 29, but it was extended. And then it also says that any deposits which the customers have with their wallets, etc., can be used or withdrawn, but no new deposits can be made. And the time limit for the withdrawal of the balance was also given as 15th March. The regulation further says that the nodal accounts of 197 Communications Limited and PPSL maintained by PPBL are to be terminated at the earliest in case not later than Feb 29, 2024. So all in all, the RBI stopped the payments bank, Paytm Payments Bank, from onboarding any new customers, from allowing customers to make any further payments after a stipulated timeline, as well as asked the payments bank or the customers to withdraw any of the funds or utilize any of the funds they have with the payments bank. Because of which the shares of Paytm actually saw a fall from the levels of 750, 800 to directly levels of 450, 500, and now furthermore to the levels of 350 post exit of senior leadership from the company. In Paytm Payments Bank Limited or PPBL, the major stakeholder is Vijay Shekhar Sharma, who is also the CEO of Paytm. He holds 51% stake, and the other 49% is held by 197 Communications Limited or OCL. Now, why did RBI issue such a regulation against PPBL? It is because since couple of months there have been multiple violations of the KYC norms of RBI against which RBI had previously also issued a notification against PPBL. Second, there were allegations of very high and direct involvement of Vijay Shekhar Sharma in the activities of PPBL. Although rightfully he holds a holding stake, however, in the day-to-day activities, such involvement was something which was seen as a red flag, which is why I think he has also stepped down from the board of PPPL recently. Third, it was also reported that Paytm as a company has been underwriting multiple customers on the same PAN number, which means it is another major violation which the RBI saw and hence issued such regulations against PPBL. And as a result, because of regulations imposed against PPBL, Paytm as a whole is suffering. One, in terms of the senior leadership exiting from the company. Second, in terms of PPBL, which was seen as a very good option, now seen as a very negative or a disadvantage. Third, because of the damage to the company as a whole, even even the lending activities, which was once seen as the major game changer for Paytm, is now something which everyone is doubting whether Paytm can do it or not. For example, Aditya Birla Finance, which was the major lending partner of OCL, has now withdrawn lending facilities for OCL, stating that the mess in which OCL or Paytm as a whole has got into seems to be very hard to come out of. Now, if you were to look at the chart of Paytm, you could see that from June 2023 there was some sort of increase in the prices of the Paytm. And this was on the context or on the thought that the lending business of Paytm would actually take up very well. So I'll discuss the lending business of Paytm as well. Now, as I've told you that the payments bank in essence cannot undertake any credit risk, which means Paytm Payments Bank Limited cannot undertake any sort of lending activities. However, OCL or 197 Communications Limited actually was undertaking lending activities not directly but indirectly. It was actually acting as a lead generation mechanism for banks and lending partners. For example, Aditya Birla Finance was using OCL as a key lead gen mechanism. For OCL, a significant business was coming from Aditya Birla Finance, who was in turn lending to the customers sourced by OCL, and then OCL was actually having two playbooks with the lending partners. First playbook was where OCL would only act as a lead generation mechanism and charge 3 to 4% to the lending partner. The second playbook was wherein the second playbook was where OCL would take some other add-on activities along with the lead gen part. For example, collection of funds. In this case, OCL would charge some more money to the lending partners on top of the 3 to 4% commission it was originally getting. Now, with the RBI regulation against PPBL, ideally speaking, there is no regulation against the lending activities which OCL is doing prima facie. However, as per the reports, Aditya Birla Finance has withdrawn its lending facilities for OCL and is not and has stated that it seems very difficult for Paytm or 197 Communications to get out of the mess indirectly and hence has withdrawn the lending facilities. So for now, while OCL can still go on and continue the lending business through other lending partners, but because of the regulations against Paytm Payments Bank, OCL is also suffering in its lending activities. All in all, once Payments Bank, which was seen to be a very good playbook and a game changer for financial inclusion theme in India, is now being questioned by many in terms of its viability as well as the business model whether it can actually be a sustainable model or not. What actually happens is something which has to be seen. However, apart from Paytm, there still exist five other players which are doing regular business, and what actually will happen or will not happen is something which needs to be seen in the recent time.